Welcome back to the Finance and Investment Channel. Can you imagine it? Right now, the trade tensions between the United States and some of its closest allies have truly reached a boiling point. We are not merely talking about the shocking 25% tariff on imported automobiles, but also about cryptic remarks concerning an outright annexation of Canada as the 51st state. Even more noteworthy is that the reaction to these developments has not come only from Canada. Across the Atlantic, Chancellor Olaf Scholz of Germany issued a statement that was anything but diplomatic in tone, proclaiming that Canada does not belong to anybody else. Canada is an independent nation, worthy of pride. Some wonder whether this fiery exchange amounts to mere rhetorical sparring among heads of state, or if it heralds the creation of a broad coalition to oppose US policy, setting the stage for a trade war that could shake global markets and directly affect each of our wallets. If you feel this subject is urgent and relevant, please hit that like button, leave a comment sharing your perspective, and of course, subscribe to the Finance and Investment Channel so we can delve deeper into these pressing issues together. At this moment though, let's roll back the sequence of events that led us here. Where did the real spark come from? And what moved Washington to make such pronounced policy shifts that even long-standing partnerships are being tested in unprecedented ways? In the next few segments, we will explore precisely that, beginning with the recent measures from President Donald Trump's second term. This is not a scenario that emerged overnight. Tensions have been mounting for months, fueled by tariff decisions and startling social media posts. But in the past few weeks, matters escalated rapidly, culminating in the loudest diplomatic row we have witnessed among Western allies in recent memory. The White House insists these moves are meant to protect American jobs, claiming that for too long, trading partners have taken advantage of a generous U.S. market while erecting barriers to American exports. In particular, the administration points to perceived threats from overseas automobile manufacturers, with a cascade of tweets, statements, and press briefings laying out the official rationale for a 25% tariff on cars, plus the potential penalties on auto parts. Yet critics, both domestic and foreign, argue that these measures not only jeopardize the free flow of goods, but also break trust among countries that have been historical allies since the post-war era. Aside from the contentious tariffs themselves, a wave of provocative statements from President Trump about folding Canada into the United States has added combustible fuel to an already volatile situation. While some observers had initially dismissed these remarks as mere political showmanship, the continued repetition of such themes over time, coupled with escalating tariffs, has prompted Canadian officials to take them more seriously. Many Canadians see the rhetoric as a brazen challenge to their national sovereignty, especially given the real economic damage inflicted by new duties on Canadian goods. In this context, Germany's vocal support for Canada, expressed through public comments by Olaf Scholz, changes the diplomatic dynamics. Germany has a powerful industrial base, and its approval or disapproval can sway the approach of the entire European Union. By uniting with Canada, Berlin is sending an unmistakable signal that such unilateral US policies will face coordinated pushback from other major economies. At stake is the entire global trading system, from steel, aluminum, and cars to intangible trust in the structure of post-war alliances. Throughout this broadcast, we will dissect how these events might unfold, what each side's endgame could be, and crucially, why it matters for individual investors and consumers who must navigate an increasingly unpredictable economic landscape. Let's start by examining the fuse that was lit in Washington, the origin of so much of the turmoil we see today. Indeed, tensions on this scale are rarely spontaneous. They reflect a pattern of recent US policy decisions under President Trump's second term that have tested the patience of allies. Let's go back to March for a prime example. In that month, the administration announced its intention to impose tariffs of up to 25% on all imported automobiles and some auto components, effective April 3rd. That decision landed like a bombshell, especially for nations such as Germany and Canada, whose automotive sectors rely heavily on American buyers. The financial ramifications are massive, involving billions of dollars in trade and potentially affecting hundreds of thousands of jobs. But that was not the end of the shockwaves. Showing little inclination to negotiate or moderate, President Trump soon took to his favorite communication platform, Truth Social, issuing warnings not only to the European Union but also to Canada. he made it clear that if those regions joined forces in opposition, they would face even steeper tariffs than initially announced. Such rhetoric straddled a curious line between menace and paternalism. The administration insisted these steps were necessary to protect the best friend each of these countries has ever had. In practical terms, it sounded like Washington was advising its allies that the new trade rules existed for their own good, whether they liked it or not. Nowhere, however, are these tensions felt more acutely than in Canada. Not only does Canada depend on the United States for a large chunk of its exports, but the friction transcends economic policy and enters the realm of sovereignty. Since December 2024, President Trump has repeatedly floated the notion, initially interpreted as a joke, of annexing Canada as the 51st state. This started as a bizarre statement at a high-level meeting, where Trump reportedly addressed Prime Minister Justin Trudeau as Governor Justin Trudeau of the Grand State of Canada. Unsurprisingly, many Canadians felt insulted by the suggestion. What initially appeared like a comic sideshow escalated when the White House, on February 1, 2025, issued an executive order slapping a 25% tariff on most Canadian goods, sparing only oil and energy items at a lower 10% rate. To justify these moves, the U.S. cited the need to narrow its trade deficit and force Canada to enhance border security against illegal immigration and drug trafficking. However, it was the not-so-subtle subtext that alarmed Ottawa. Trump implied that all such punitive measures could be waived if Canada agreed to become the 51st state. "We must protect Americans, and my job as president is to ensure the safety of all," Trump declared, layering national security with an evident challenge to Canada's independence. Suddenly, the lines between policy posture and sovereign encroachment blurred, fueling real anxiety in Canadian political circles. Mark Carney, newly installed as Canada's Prime Minister, publicly warned that these proposals were too significant to dismiss as mere bluff. He went on record expressing concern that America's growing appetite for Canada's vast mineral resources might be the real engine driving talk of annexation. Meanwhile, Minister of Transport and Domestic Trade ANADA Anand underscored Canada's unwavering commitment to guarding its frontiers. What initially sounded like a speculative scenario had now become a stark reality, as direct economic and political pressure converged to push Canada into a corner. As matters worsened, global observers began scrutinizing the once stable partnership between Washington and Ottawa. Rarely had American-Canadian relations descended into such tension. People wanted to know, how would Canada respond? Would it be forced to concede or remain stoic in the face of economic hardship? And more broadly, how might these tensions in North America connect to global markets? Especially considering that political risk can cause price swings in stocks, currencies, and commodities? Let's explore Canada's fierce rebuttal in the next section. Amid these mounting pressures, Canada decided that enough was enough. Both the Trudeau administration, before Justin Trudeau stepped aside, and the new Carney administration agreed that simply enduring U.S. maneuvers was unsustainable. The result was a surge of national solidarity. Never before in recent Canadian history had so many factions, ranging from political elites to grassroots activists, aligned against perceived American overreach. Prime Minister Mark Carney's response was direct and unambiguous. These tariffs represent a direct attack on Canadian workers and a blatant betrayal of our long-standing trade agreements, such as CUSMA, he said, referencing the successor to the original NAFTA. Statements alone, however, would not suffice. Carney convened urgent meetings with leaders from business, labor unions, and regional governments to coordinate a robust national strategy. The most notable outcome was the creation of a Strategic Response Fund, initially capitalized at $2 billion Canadian dollars. That substantial figure demonstrated the seriousness with which Canada was taking the confrontation. Its goals were fourfold. First, to protect jobs, particularly in the auto sector, which is heavily reliant on U.S. trade. Second, to reduce dependence on U.S.-based supply chains by incentivizing Made in Canada initiatives. Third, to help struggling businesses ride out the storm via tax deferrals and liquidity support. And lastly, to earmark the eventual proceeds from any Canadian counter-tariffs for direct assistance to affected workers. Meanwhile, a wave of nationalist sentiment swept the country. On social media, hashtags encouraging Canadians to boycott American goods and buy locally produced alternatives went viral. People shared photos of big box retail aisles, Costco, Walmart, and others, showing shelves stocked exclusively with domestic brands. Retailers even started labeling certain sections as Canada First, spotlighting homegrown merchandise and urging consumers to make economic choices that reinforce national sovereignty. Some might have seen this as an emotional overreaction, but in the eyes of many Canadians, it was a patriotic duty. This wave of defiance also extended into cultural symbolism. A clothing brand in Ottawa, for instance, released a bright red baseball cap emblazoned with the slogan, "Canada is not for sale," an obvious jab at Trump's "Make America Great Again" hat. The new design rapidly caught on. Politicians across various party lines wore it, as did public figures from entertainment and sports. Perhaps the most telling moment was when Ontario Premier Doug Ford, long regarded as business-friendly and occasionally sympathetic to American interests, displayed the cap during a press conference. Observers interpreted this as a dramatic statement of unity transcending partisan divides, signifying a collective defense of Canadian interests. Protests erupted in major cities such as Toronto, where large crowds gathered outside the U.S. consulate. Marchers brandished signs proclaiming "elbows up," referencing a colloquial expression of steadfast determination. Addressing one demonstration, Member of Parliament Charlie Angus decried, "We will never become the 51st state of the United States. We will not kiss the ring of the Trump dictatorship." His words reflected widespread outrage, capturing both the indignation and resolve that cut across Canadian society. Simultaneously, the shift in tourism patterns spoke volumes. Instead of traveling to longtime U.S. vacation spots, many Canadians opted to explore their own country, boosting domestic airlines and cross-Canada train routes. Flight bookings to the U.S. reportedly plummeted by as much as 70%. This exodus delivered an unmistakable economic message to Washington. Internationally, sympathetic voices in Australia, France, and Scotland signaled their support for Canada's stance, revealing how widely the story had spread and how deeply it resonated. Still, while Canada's moves were forceful, few believed they would single-handedly realign U.S. trade policy. The real turning point came when another major power, Germany, stepped into the fray. It was not merely rhetorical solidarity, but a strong demonstration of readiness to counter Washington's approach. The impetus for Germany's involvement originated at a premier industrial expo in Hanover, which we will examine next. Enter the Hanover Industrial Fair on April 1st, 2025, one of the world's foremost technology and manufacturing expos. In a striking turn of events, Canada happened to be the official partner country this year, sending hundreds of companies to showcase innovations and seek new partnerships. The stage was set for a high-profile display of Canadian resilience amid U.S. pressure. But the real bombshell came not from a Canadian official, but from German Chancellor Olaf Scholz, who delivered a keynote speech that would ripple across the Atlantic. Unlike many political addresses at industrial fairs, often formulaic celebrations of technology and trade, Chancellor Scholz's remarks engaged head-on with the biggest controversy of the hour. Referring explicitly to the swirl of rumors about annexing Canada, he declared, "Canada does not belong to anybody else. Canada is an independent nation, worthy of pride." His words left no ambiguity. They signaled a resounding rejection of any notion that Canada's sovereignty was negotiable. The reference, implicit or explicit, to President Trump's hints about the 51st state was unmistakable, and the timing could not have been more opportune. Scholz emphasized that trade disagreements must not escalate into bullying tactics or disregard for ally independence. In fact, he warned that unilateralism in global trade could only lead to losers, referencing the fractious experiences of the 1970s and cautioning that higher tariffs often unleash retaliations detrimental to everyone. Calling out the U.S. policy of imposing a 25% tariff on auto imports, which was scheduled to take effect just days later, Scholz characterized it as a regrettable error that might push the global economy toward a trade war. The Chancellor's references to the need for freer trade, cooperation, and mutual respect carried implicit condemnation of the White House's approach. What made Scholz's remarks especially poignant was his clear position that the European Union as a whole, of which Germany is the economic linchpin, would not stand idly by if Washington continued enacting aggressive duties. By offering public solidarity to Canada at a stage where both countries were front and center, Scholz suggested that the EU might form a united front to counter America's tariffs. As a result, trade experts began pondering a question that had previously seemed remote. Could the EU coordinate with Canada to challenge US dominance in certain sectors, or impose its own retaliatory measures on American goods? To appreciate the potential ramifications, consider the significance of Germany's auto industry. In 2024, German automakers like Volkswagen, BMW, and Mercedes-Benz exported roughly $25.6 billion worth of vehicles to America, over 13% of Germany's total automotive exports. If those cars face sustained tariffs of 25%, competitiveness would erode rapidly, likely shrinking German exports by 30% or more. Meanwhile, President Trump's message was defiantly unconcerned about price hikes for foreign vehicles, effectively telling the world that these taxes were non-negotiable and indefinite. In Germany, such bravado sparked outrage. Commentators framed it as an attempt to sabotage German manufacturing might and possibly as a lever to extract political concessions from an allied nation. In short, Chancellor Scholz's public stance was not idle grandstanding, but a concerted push against an economic threat that would directly harm Germany's critical manufacturing base. By highlighting Canada's sovereignty while simultaneously condemning US tariffs on automobiles, Scholz signaled that major European powers were ready to go toe-to-toe with Washington. Far from isolated or merely reactive, this move seemed carefully choreographed to remind the US that historical allies could coordinate against American aggression. The big question was whether these rifts would deepen into a full-scale trade conflict or perhaps produce a diplomatic compromise. Yet any illusions that Berlin would remain passive vanished. Next, we'll examine the likely evolution of this emergent alliance of the unwilling and how it might reshape global trade alignments. Chancellor Scholz's admonitions at Hanover, standing in solidarity with Canada, did more than make headlines. They also raised the specter of a broader coalition forming among nations that feel threatened by US policies. In his speech, Scholz had alluded to Europe's readiness to respond collectively if Washington continued to adopt unilateral measures. This approach gained traction at the European Commission in Brussels, which had already been debating possible retaliatory duties in response to the 25% tariff on imported autos, along with other prior US actions on steel and aluminum. Indeed, Commission officials privately circulated lists of American products, from agricultural goods to consumer brands, that could be targeted by EU tariffs if matters deteriorated further. From a strategic vantage point, the European Union and Canada share a strong incentive to collaborate. Each has substantial economic ties to the United States, but they also possess advanced industries and are signatories to CETA, the Comprehensive Economic and Trade Agreement, which fosters trade between Canada and the EU. Now confronted by Washington's trade onslaught, both parties see impetus to diversify away from a seemingly unpredictable American partner. The objective is not merely to react, but to establish alternative supply lines and alliances, should the US prove unyielding. Such a realignment could expand beyond tariff policy, potentially impacting research collaboration, technology standards, and investment flows. Further fueling this potential front is the close cooperation of Germany and Canada in scientific and technological realms. Their long-standing agreements date back decades, covering areas like clean energy, advanced manufacturing, and artificial intelligence. In recent years, both nations have accelerated their plans for a transatlantic hydrogen alliance, with aims to ship Canadian-produced green hydrogen to European markets. If the US erects trade barriers, Berlin and Ottawa have even more reason to deepen these initiatives, building a new partnership that might decrease dependence on American resources or markets. The synergy between the EU's appetite for cleaner energy and Canada's vast potential for sustainable power sources could become a cornerstone in forging a stronger bilateral axis. It would be simplistic to assume that Germany and Canada alone can fully shield themselves from US economic might. The United States remains the largest consumer market in the world, and both countries benefit significantly from selling goods there. But they appear prepared to accept short-term pain to safeguard a principle that no one nation can single-handedly dictate global commerce. As Olaf Scholz put it, Europe is neither naive nor weak. Canada, facing annexation rhetoric and a barrage of tariffs, has shown it will not capitulate. This shared defiance could turn the tide in how allies respond to U.S. protectionism. No longer do they stand disunited, tackling American pressure piece by piece. Instead, they seem willing to coordinate, forming a united bulwark. For Washington, this poses dilemmas. Historically, the U.S. has had leverage by virtue of its vast market. When dealing with smaller allies separately, it could push them into unfavorable deals or incremental concessions. But dealing with a coalition or front that includes the EU is decidedly tougher. And the more extreme Trump's pronouncements, such as annexing Canada, the easier it becomes for other nations to join forces against perceived American overreach. In essence, it becomes an international question of whether the United States can continue to call the shots unilaterally, or if the global community has reached a point where pushback is consistent and formidable. Of course, these dynamics ripple beyond official proclamations. Markets react, supply chains shift, and corporations scramble to reposition. Companies operating in North America and Europe must reevaluate strategies. Should they relocate factories to avoid tariffs, revise distribution networks, or hold back on expansions in uncertain regulatory environments? Meanwhile, the specter of trade war mania spooks investors worldwide, fueling concerns about inflation, disruptions in shipping, and a potential downturn in consumer sentiment. In the final section, we'll reflect on the essential lessons that individual investors might glean from the tangled web of US-Canada-Germany relations and how global realignments can influence their portfolios. To put it mildly, the unfolding confrontation between the United States, Canada, and Germany offers abundant case studies on how geopolitics can rock financial markets and business strategies. For individual investors, the first lesson is to never underestimate the impact of political tensions, especially among long-standing allies. Historically, Western economic ties were stable enough that many analysts discounted the possibility of an internal rift reaching this level of severity. Yet here we are, witnessing an open dispute over car tariffs, threats of economic retaliation, and even talk of annexation. When such surprises occur, they can upend assumptions about supply chain reliability, currency movements, and consumer spending patterns. The second big takeaway is that diversification is king. Consider the automotive sector. If your portfolio is heavily weighted toward automakers reliant on unimpeded U.S. access, the proposed 25% tariff might erode profits and valuations. The same principle applies if you own stock in steel or aluminum producers either set to benefit from U.S. tariffs or lose out due to foreign retaliation. Broad-based funds or ETFs that track multiple regions and sectors can help cushion unexpected shocks. Similarly, businesses reliant on a singular market might face abrupt swings in fortunes if that market imposes protective barriers or experiences slowing demand. Third, the intangible elements of brand loyalty and national pride can shape economic outcomes. Look at how Canadians rallied to boycott American goods, or how new consumer behaviors emerged, such as exploring domestic tourism over familiar cross-border excursions. This phenomenon might, in the short term, dent U.S. service industries that rely on Canadian visitors, including airlines, hotels, and retail outlets near the border. Meanwhile, if German citizens perceive that American tariffs or threats undercut their own national interests, we may see parallel shifts in European spending habits or contracting deals that exclude U.S. partners. Emotions and identity can be a potent driver of economic decision-making, a reminder that rational cost-benefit analyses do not always determine buying or investing choices. Fourth, keep an eye on long-term technological and economic transitions that overshadow immediate politics. The newly fortified alliance between Canada and Germany on hydrogen energy, for instance, points to future opportunities in green energy markets. By reducing reliance on the U.S. for certain resources or by forging new shipping routes, these two countries could pioneer breakthroughs in renewables, data management, and advanced manufacturing. Once these systems gain traction, they might become more resilient to short-term trade tensions, offering a stable runway for investment growth. Investors who watch these macro shifts and understand the legislative or regulatory frameworks behind them could identify early entry points in promising sectors. Finally, one must remain cool-headed. The markets have a tendency to oscillate sharply on sensational headlines. A tweet or a press conference might spark panic or euphoria, but rational analysis requires stepping back to assess fundamental drivers. Is the global economy truly headed for meltdown, or is the dispute likely to yield partial compromises? Will either side blink if a trade war starts to harm domestic constituencies through job losses or inflation? Historically, the arc of multilateral disputes has sometimes bent toward resolution, albeit after turmoil that can rattle short-term investors. If you have a clear plan, a well-structured portfolio, and patience, you can ride out these tempests in better shape than those who resort to knee-jerk reactions. In light of these factors, the ongoing friction between the US, Canada, and Germany is more than just a dramatic political narrative. It showcases how national pride, strategic resource planning, and advanced industrial ties converge to influence everyday economic realities. As always, caution and curiosity are the best companions for navigating the unknown. Next, let's integrate these insights into a broader conclusion, highlighting the main lessons gleaned from this complicated standoff and suggesting ways forward for vigilant investors. Reflecting on this intricate saga, several overarching themes stand out. First, the friction between Washington and Ottawa, originally interpreted as a spat over trade deficits and automobile tariffs, escalated drastically due to rhetoric about annexing Canada. The harshness of those remarks, though initially dismissed as offhand jokes, eventually alarmed Canadian leaders and galvanized a unified national response. This underscores how swiftly political discourse can evolve from mere bluster to an economic flashpoint, especially when sensitive subjects like sovereignty come into play. Second, Canada's retort went beyond official pronouncements. Citizen-led boycotts against American goods, the adoption of the Canada is not for sale cap as a statement of defiance, and a pivot toward domestic tourism all reveal how deeply the conflict seeped into social consciousness. When entire populations decide to shift spending patterns in protest, the ripple effects can be powerful, targeting specific industries and localities reliant on cross-border business. From an investor standpoint, this underscores the necessity of tracking consumer sentiment, a variable sometimes discounted in purely numeric analyses. Third, Germany's role was the linchpin for transforming a bilateral US-Canada tussle into a broader realignment. By standing resolutely with Canada and criticizing President Trump's trade aggression, Chancellor Scholz not only sent moral support, but also hinted at the possibility of collective EU countermeasures. This step introduced a major wildcard for the US. Administration. Confronting Canada alone is one thing, but tangling simultaneously with the economic heft of the EU is another matter entirely. In future, other world powers may similarly rally if they perceive American unilateralism threatening them, potentially redrawing alliance lines and affecting global supply chains. Fourth, beneath the headlines, a quiet but meaningful shift in economic strategy is unfolding. Canada and Germany, bound by existing ties in science, technology, and especially green energy, are intensifying their cooperation. CETA already reduces trade barriers, and new dialogues on hydrogen exports exemplify attempts to create resilient supply networks that are less vulnerable to abrupt US policy swings. Such long-range planning hints that these nations anticipate continued volatility from Washington and see value in forging partnerships that expand their resilience and independence. That synergy could, in the medium term, open up fresh investment opportunities in renewables, advanced manufacturing, and logistics. By the same token, it signals that once monolithic trade blocs, such as North America anchored by the US, may gradually lose attractiveness if unpredictability becomes the norm. Lastly, for everyday individuals, from entrepreneurs to retail investors, the episode is a stark reminder that global economics rest on political cornerstones. We cannot compartmentalize policy as just talk when it has repercussions measured in billions of dollars, jobs lost or created, and disruptions of entire industries. For instance, the auto sector stands on the precipice of rethinking production strategies if tariffs remain or intensify, while steel and aluminum producers monitor possible retaliations that might close foreign markets. Currency fluctuations could accompany these changes, with the Canadian dollar or euro gaining or losing strength depending on the success of each new trade arrangement. Savvy investors will watch such shifts closely, recognizing that political risk can alter valuations. All these threads converge to paint a portrait of a rapidly changing landscape. No single storyline within this standoff, annexation talk, the 25% car tariff, or Germany's defense of Canadian sovereignty, can be dismissed as a sideshow. Together, they illustrate how quickly alliances can strain, how nations can band together, and how advanced economies navigate crises that blend symbolism with material consequences. The result may be a new equilibrium in which multinational ties are more fluid. Having explored these elements, let us move to a final summation, highlighting the major implications for investors, businesses, and the shape of global trade in the near future. To conclude, the drama playing out among the United States, Canada, and Germany goes far beyond mere saber rattling. At stake are core questions of sovereignty, economic survival, and international cooperation. On one hand, the Trump administration's imposition of a 25% tariff on automobile imports and the provocative talk of adding Canada as the 51st state reflect a willingness to use extreme measures to reshape global trade relationships. On the other hand, Canada's fierce reaction, combined with Germany's vocal support for Canadian independence, shows that this time, Washington's partners may not passively accept American demands. The resulting friction threatens to disrupt well-established markets, from the auto sector to advanced materials, and sets off alarm bells among investors concerned about the possibility of worldwide tariff wars. As an individual investor or consumer, it is prudent to follow the evolving narrative with diligence. Markets tend to recoil at political uncertainty, and these tensions encompass not only commerce, but also the sensitive matter of national identity. That potent mix can spur abrupt changes in consumer preferences, supply chain routes, and corporate earnings forecasts. We could witness significant shifts in currency valuation, especially if major powers collectively retaliate. Moreover, if a wave of job losses strikes the auto sector in Europe and North America, consumer spending might dip, creating a negative feedback loop. Indeed, the potential for far-reaching repercussions cannot be overstated. Nevertheless, it would be too simplistic to assume that a full-blown crisis is inevitable. Historically, alliances among major democracies have proven resilient. Time and again, heated disputes eventually yield compromise solutions, though not without a degree of pain. We cannot predict with certainty whether this standoff will ultimately lead to moderated tariffs, new bilateral deals, or deeper schisms. But the volatility in the short run seems undeniable. While mainstream investors may retreat, more risk-tolerant individuals might see dips in stock prices as opportunities to buy undervalued equities, especially in companies that might adapt effectively to evolving trade barriers. Meanwhile, conservative strategies such as diversifying into multiple regions and sectors, or holding inflation-resistant assets like certain commodities, can offer a measure of protection if a trade war escalates. On a macro scale, the reconfiguration of transatlantic relationships looms large. If Germany coalesces with Canada, forging new avenues in green energy and technology, the US might find its once unrivaled influence waning in specific fields. That said, the American market remains a juggernaut, meaning these allies must tread carefully to avoid severing ties that still confer mutual benefits. Over time, however, the push to reduce reliance on the United States may yield unexpectedly robust networks of economic interdependence across Europe and North America, minus US leadership. This synergy could have broad implications for everything from corporate supply chains to cross-border research and tourism. From a personal finance standpoint, it is wise to keep emotions in check. The swirling headlines about threats and counter-threats can lead to impulsive decisions. Maintaining a balanced portfolio that accounts for these uncertainties is often a better strategy than chasing short-lived trends. Keeping an eye on reliable news outlets, analyzing statements from key officials, and tracking how large corporations are adjusting their strategies can all help you anticipate the direction of the storm. By doing so, you can position yourself to weather the turbulence or possibly even profit from it, while others act out of fear or misunderstanding. In sum, we are witnessing a multi-layered confrontation that involves trade tariffs, sovereignty conflicts, and the potential emergence of new strategic alliances. The question is not merely whether the US, Canada, and Germany can mend fences, but also how these events could reshape global economic structures in the coming years. Thank you for joining us on this detailed journey through the evolving crisis. If you find this analysis valuable, please like, share, and subscribe to stay informed and gain fresh perspectives on finance and investment in a rapidly changing world. Until next time, stay calm, stay analytical, and keep your eye on the long-term horizon.